Hello, welcome back, guys. This is day 2, video number 1, as I promised you. So, in this particular video, I am going to talk you about the difference between business risk and risk of material misstatements. So, generally, without wasting a time, we'll proceed to our discussion. Okay. So in question number one generally consists of, not generally but most probably it will be tested on three topics. One is audit risk, second is risk of material misstatement, and third thing is business risk. So now audit risk is kind of similar to risk of material misstatements. So once we discuss risk of material misstatement and business risk, the next video will be depend on audit risk, which is short and simple video. Okay, so let's start with risk of material misstatements. Risk of material misstatement, the bookish definition for risk of material misstatement is risk that the financial statements are materially misstated prior to audit. It comprises of inherent risk and controlled risk. It comprises of inherent risk and controlled risk. So now what is inherent risk and what is controlled risk? Inherent risk means financial statements are materially misstated right from the inception, like it has inherent limitation. Now what does it mean, inherent limitation? Inherent limitation means uh, even though audit is not conducted, misstatement will be there in your financial statements. So that is inherent risk. And what is controlled risk? Controlled risk means, okay, so let me put you in a different way. So control risk means what? Risk of material misstatement existed, or there is a risk of material misstatement in the financial statements after implementing controls. After implementing controls. Okay. And inherent risk is what? Risk of material misstatement in the financial statements before implementing before implementing the controls. Now, what does control means? Internal financial controls. IFC audit is one of the major area now. It is being developing in these upcoming years. So, what is control? Control means safeguardings. What are the safeguards? Like uh, maker checker policy, then proper authorization, authentication, password, etc. These are the controls. So after putting these controls, even though there is a risk in financial statements, then it is a risk of material misstatement. It is a risk of material misstatement. So basically, risk of material misstatement is equal to inherent risk plus control risk. Inherent risk plus control risk. Inherent risk plus control risk. Okay. So this is the bookish definition. Now we'll understand the techniques of risk of material misstatement. As you guys are aware that the question will be case study based. So how you will identify whether this particular risk is risk of material misstatement or not. So think from this perspective, like inherent risk. So check whether there is any control existed in financial statements or not. Okay. Second step will be, if the control is existed, if there is a control, then check whether these controls are effectively. These controls are three things: operating effectively, effectiveness, and continuity. Okay, check whether that is your sub analytical perform analytical procedures. This will be your step 3. So these are small techniques which you need to think in your mind. Okay, so I hope you are getting what is risk of material misstatement. Risk of material misstatement is risk that financial statements are materially misstated prior to audit. It consists of inherent risk and control risk. Now we'll move towards our next discussion, which is business risk. Now what is business risk? Okay, I will give you the bookish definition, but trust me guys, it is of no use. Seriously, it is of no use. If you want to um, apply the business risk concept correctly technically in your case study, then just one simple trick. Whenever the question comes on business risk, first read the case, identify the case studies, and think please think like you are the businessman. You are a businessman. You are actually invested a lot of money into that particular case study, and how adversely or how favorably it is going to impact on your business continuity, continuity. Okay, so think like that. You are a CEO. Suppose now there is a case study. Suppose, for example, um, um, Papillon company has invested 10 millions in land which is far away from the beach, and they are planning to construct resort a beach resort. And okay, let's say, check it. Papillon company had purchased a land near a beach for 40 million, and they are planning to construct a beach resort over there. But due to the environmental organizations, they have imposed restrictions on construction of beach resort, because as per them, beach resorts are going to damage the beach and adversely to the environment. Okay, so now think from business perspective. Like, there is a business risk. I have invested 40 million in that particular purchase of land near beach, but now I cannot utilize that um, for my revenue generation. So it will adversely impact how it will adversely impact my going concern. It will adversely impact my share price if the company is listed. And third thing is, it will give adverse message to the investors, creditors, and the uh, prospective financial investors, right? So this is how business risk works. So I hope you have understood the concept of business risk and risk of material misstatement. I know these are the small techniques you need to apply, but if you want to apply it very effectively, just do one thing: solve or read two questions of business risk. Read the question, read the answer. Okay, just read two questions, and after two questions, the third question, read the case study, prepare the answer in your head or write it down somewhere, cross check it. Do this 2 or 3 times. I am very much sure that you will score good marks if you do this study plan. Thank you so much. Good day. God bless you.